Many people accept that quantitative easing, easy monetary conditions, low interest rates, printing money causes asset prices to go up. On the same note, they just accept that quantitative tightening and raising interest rates causes asset prices like stocks to fall. But what is the mechanism behind this? In this video, I'm going to explain the process very simply, how QT contributes to lower stock prices. Ready? Let's dive in. I make these videos to teach you how money works so that you can make more, save more, and give more. And one of the ways that I come up with these ideas for videos is actually not me coming up with them. It's you guys asking me questions. And Free My Economy on Twitter recently asked me how QT, or balance sheet reduction, contributes to lower stock prices. So we're going to go through that process and I'm going to explain exactly how that happens. So, number one, the easier thing to understand is how QE causes stock prices to go up. So we're going to start there so that we can see the reverse. When money is being printed, it has to go somewhere to do something. So the Federal Reserve and banks can both cause money to come into existence. They can print money. They create money. They grow the money supply. The way they do this is through a loan, through debt. So when you go to the grocery store, you swipe that credit card, those are new dollars coming into existence that did not exist before. And then when you go to work, you take dollars out of circulation from your paycheck, they give them to you into your bank account, and then you go pay off that credit card debt. That's dollars leaving circulation. So debt will loan money into existence, and then when that debt is paid off, that money ceases to exist. So banks do this through debt. The Federal Reserve is just a bank to other banks. That's what a central bank is. They do this through debt as well. But they don't do it for, debt to you and me like a commercial bank will. They do this with debt to the government or through purchasing assets like mortgage-backed securities. And so they will purchase a treasury, which is a government loan, and that way the government owes them money. So they'll print $1 billion, they'll loan it to the United States government, and now the United States government will owe those dollars back to the Fed at, 2%, 3%, whatever the interest rate is. So the Fed prints money and loans it into existence through the federal government, and then the federal government can go out and spend that money wherever it chooses to spend that money. Banks will also loan money into existence, and the lower interest rates are, the more banks will do this because the higher the appetite is for borrowing. If you can borrow at 10%, you might not do it. But if you can borrow at 1%, you're more likely to do that because debt is cheaper. So when the Fed is doing QE, that means their balance sheet is going up. That means they're buying assets. What they're really doing is loaning money to the government so the government can spend more money. When interest rates are low, banks are lending more money into existence. Both of these mechanisms cause more money to start circulating throughout the economy. When more money comes in, it bids up prices because that money is all coming into people's bank accounts. So whether it's the federal government spending that money on politicians' bank accounts or through Social Security, Medicare, military contractors, whatever it is, that's money going into companies or individuals' bank accounts. And then those people or companies spend that money on something else, whether it's employment or goods or services or whatever it is. And then that money goes into other people's bank accounts. And as that money goes throughout the system, every single step along the way, every time it gets transferred, it is buying something. And so the more money that comes in, you have more buying pressure for everything on aggregate in the system, pushing up prices. Same thing when you go to the store, you swipe that credit card, when you get an auto loan, when you get a mortgage, more money coming into existence that filters its way throughout the economy, pushing up and lifting up prices. Like a tide lifts all boats, more money comes in and lifts up all prices. It's key to understand, though, that this monetary expansion is on debt. It's not as if this money was just printed into existence and sent out to be circulated. It's always on the back of debt. It is loaned into existence, whether it came from the Fed or came from banks. Because if it came from the Fed, it goes to the government in the form of a bond, which is debt. This means that through the process of quantitative tightening and hiking interest rates, it makes the money supply start to decrease. Because if you're rolling over your debt balance every single month on your credit card because you've got a 0% introductory rate, you might be fine. But as soon as that interest rate goes up to 15 or 20%, you don't want that anymore. So you're going to do what you can to pay it off. And if you can't pay it off, even so, it's still sucking up more of your monthly income to pay those higher interest payments. And it's the same with all debt across the entire economy. We've had a long period of low interest rates and growing debt. And now that interest rates are going up, that debt service cost, just paying off those minimum payments, whether you're a company, a government, or an individual, is getting harder. It's sucking money out of circulation because that debt is either getting paid off or getting more expensive or both. Further, quantitative tightening or balance sheet reduction, when the Federal Reserve sells assets off of their balance sheet, they're sucking dollars back out of circulation because they're going out into the open market. They're saying, hey, the federal government owes us money right now, but we're going to see if anybody else wants to take that contract and have the government owe you money instead. And if you do as a bank, I'll sell it to you. I'll take $1 billion. You take $1 billion worth of debt. I'll take that $1 billion of cash, but I'm the Fed. So that money ceases to exist just like it would with a bank. And so through the process of interest rates going up and through the process of the Fed selling assets off their balance sheet, money is getting extracted out of the economy and no longer in circulation. This has the exact opposite effect of QE, what we talked about before, because there's less money to go around. And every time money is spent from one person to another, one company to another, that's my expense, it's their income. So to the extent that money leaves circulation, everywhere on aggregate, that is less income. Now, big money knows this. They understand this, and they understand that means that times get tougher. People can't afford to continue to buy all the stuff that they used to be able to afford. People can't maintain their lifestyles because their incomes go down. Maybe not everybody's incomes go down, but on aggregate they do. Some people lose their entire incomes. Some people might get just a pay cut. You might have just a slowdown in growth of incomes. And so big money understands this. They understand that corporations and companies as well won't be able to reinvest as much money in growth. They'll have to start making larger debt service payments. There's less money to go around, so profits and revenues get squeezed. Big money knows this is happening, and they understand that that's what's coming down the road eventually. Not yet, but it's coming down the road eventually, which means they're going to sell. Understanding that quantitative tightening, raising interest rates leads to harder economic conditions, recessions, crashes, unemployment, means that those companies are not going to continue to go up and to the right like they were before during the easy conditions. The only reason to own a stock is if that number goes up. And so me, big money, knowing that that number isn't going to go up anymore, I'm going to sell. And so the more of people like me who decide I'm just going to sell because times are going to be tough, that's going to cause those stock prices to drop because now there's more selling in anticipation of the hard economic times that haven't hit yet, but are likely to hit in the future given the tightening. And then the lower asset prices turn into a little bit of a self-fulfilling prophecy because those lower asset prices now mean that that growth in those asset prices has gone away. You have a reduction of the wealth effect or an opposite effect on the wealth effect, a negative wealth effect, where you have people having to sell their assets in order to make ends meet. You have people feeling poorer, so they try and save more, stop spending, and you contribute to a slowdown in velocity, less money circulating throughout the economy, which makes those hard times potentially, at least temporarily, even harder. And this is why I always say that whether we have inflation or deflation, it works its way throughout the economy by hitting asset prices first, then goods and services, and then wages, because that's the process by which that money works its way throughout the economy. Whether it's more money or less money, that's the process by which it hits first. And the rich, who know what happens and understand how the game is played will start to either buy or sell those assets ahead of the economic conditions actually changing. Which is why, like I said in the beginning, I make these videos, because you have to understand how the economic machine works, because those are the rules of the game. And if you want to play to win the game, you have to know what the rules are. So you have to understand how the money mechanics work in order to perform the correct actions that will get you more of that wealth. And I want you to be able to make as much money as possible, create as much wealth as possible, so that you can protect it and save it and keep it, but also so that you can be extremely generous to everybody who needs it. Because those of us who have the most wealth have the most responsibility to care for as many people as possible. That is the point of it. And if we hold back our wealth with clenched fists and are selfish with it, it will ultimately be taken away from us. So I hope that explanation helps. Let me know if you have any questions or thoughts in the comments section below. And as always, I really appreciate you guys. Thanks so much for watching. Have a great day.